Hey guys, what's going on? Thanks for checking into the channel. Today I wanted to do this video for a little while, all about appraisals. So hopefully if you're here for that, please press the like button, subscribe to the channel if you haven't already, and let's dive right in and talk about appraisals. The lender has no affiliation to the value. They have no clue what the value of the property is. They're counting on a third party to tell them whether the lending parameter, meaning loan to value, is actually in line with what's being submitted to them. And it's interesting because they have no way to validate it unless they hire a third party to in fact go out there and give them that information. So for that, you order an appraisal. Now, what I want to talk about is the compliance piece, which is the first thing. And the reason is because you have to order the appraisal, and then a lot of time, if you're working with real estate agents in a purchase transaction specifically, first question is, did you guys order the appraisal? Okay, well, I want to take a couple steps back and answer how that process actually works. Because you see, when you actually register a loan to the lender, meaning I'm telling a lender, this is my package, this is my borrower, please review it all. This is the time that a lender actually takes a look and says, yeah, this is actually in line with the type of loans that we do. And what they'll do is they'll issue electronic disclosures to the borrower. There is two documents in that package. One of them is called a lender's estimate. And once that lender's estimate is issued to the borrower, the fees cannot be changed. Which is really unique, because if a lending shop issues a lender's estimate and then later want to change fees, they cannot. It's locked. So if they miss the fee, they actually have to pay for it themselves, even if the fee doesn't come from them. And now the second part of it is something called an intent to proceed. The reason I'm bringing this up is because until those two documents are acknowledged, you can't actually order an appraisal even if you wanted to. You cannot charge a borrower for anything until the intent to proceed and the lender estimate are acknowledged. So that would be number one. An appraisal costs approximately $500. Let's talk about something else. There are two agencies which I mentioned in many of my videos, and they buy loans on the secondary market, meaning that these lenders typically fund loans on a credit line. Imagine like you have a home equity line of credit and you buy things, and then a bus comes and you load your loans, and then they write you a check for what you paid, and then now you have your credit line back. So that's typically how it works. Now, the reason I bring that up is because these agencies also issue something called a PIW, which is a physical inspection waiver. Subject to certain things that are checked off in the guidelines, if you meet certain criteria, you may be eligible for a PIW, a physical inspection waiver. And if you are, then there's no need to order an appraisal. So your transaction takes place with an electronic verification of value, let's just say, right? And so you wouldn't have to order an appraisal, which is phenomenal. You'd save yourself approximately $500. Now, if a property is larger and more complex to size up, sometimes it's unique, sometimes it's in a tough part of town, it's hard to get to it, sometimes there's no comps available, comparable sales, the appraiser might take longer and might actually charge more to do the appraisal report. There's a difference between doing an appraisal for an owner-occupied than doing an appraisal report for an investment property. And the reason is there's only one report required for an owner-occupied property. It's called the 1004 report. However, when you are doing a report for a non-owner-occupied, then what you have to take into consideration is the value of the rents. And the reason is because now, or many times, you're using rental income to qualify. Now, if you're not using rental income to qualify, and I'll elaborate on that in a second, then you don't need to order the second report, which typically costs somewhere between $150 to $200. It's called a 1007. If you're not using rental income to qualify, think about it this way. I'm gonna buy an investment property that's gonna have a debt, let's just say, of $1,000 a month. The property can also collect $1,000 a month in rental income, which means that technically I'm close to offsetting my debt, right? Not 100% because the lender only uses 75% of the rental income. So I'm hit with 1,000, getting credit for 750, which is 75% of 1,000. So I have a liability of 250 a month using rental income to qualify. Now, two different things. Typically speaking, it takes about a week for the appraisal report to come back. So from the time it's being initiated, the appraiser goes out there, you could typically expect about 5 days to get the report back. If there's a 1007 attached to it, which is the comp schedule, it could take another day or two. Sometimes the reports come back and they go directly to the lender. It's the appraisal department, and there's requested revisions. So there's requested revision, it actually needs to go back to the appraiser. They make the revision, typically doesn't take more than a day or two, and then you get your report. All right, and technically most of the time, from my experience, the reports are issued at the same time to both the mortgage broker and to the borrower. So there's usually no delays. There is something called, and you may have heard this in the past, a desktop value. So desktop valuation simply means that whomever the lender is, they're using a desktop review of comps that are available to them through online engines. As an example, Redfin, Zillow, Realtor.com. They can actually pull comps and see that the value of the property is in line with what it is that they're about to lend, okay, in terms of ratios. This comes into play a lot when you're dealing with doing home equity line of credits. And the reason is a home equity line of credit is typically a free product to a borrower through most banks and credit unions. So they don't really want to go through the charges of paying for an appraisal unless you disagree with the value of the desktop and you request an appraisal. And at that time, you can actually pay for a third party to go out there, which again, plus minus, is about $500. What happens when a property is mid-construction, or if you want to go through construction? How do you treat the appraisal process? Well, so now we need a report that covers two things. One is the current value, which is the as-is value, and the second thing is the future value. It's called an after repair value, ARV. So construction properties, properties that you're adding on to, renovation properties, we don't know what these things are going to be worth after the fact. And so we're going to get a report that shows the as-is and the after repair value. And the reason we're doing that is because the lending parameters are going to be based on the after repair value. You might get a certain amount of money today, and a certain amount of money likely is going to be held in something called a fund account. Okay, so based on the stages of your construction, fund control will actually control the amount of draws that you get until you get to that ARV value. Because imagine if I'm telling you a property is going to be worth $2 million tomorrow, it's worth $1 million today. I can't lend based on $2 million because the investor is going to take massive risk if you release a lot of money, unless you control the risk. You hold it in a fund account and then you release it in stages. As more money is being injected into the property, it gets closer to that $2 million mark. Hopefully that makes sense. The first thing we look at when we get an appraisal. Now you might be thinking you're looking at the value, it's so easy. Yes, I am looking at the value. However, one other thing I'm looking at is whether it's an as-is or a subject to appraisal report, which is super important. Because as-is means that the appraisal just came in at face value. There's nothing else I need to do. Subject to means that the appraiser noted that there's something with the property that needs to be corrected, and then the seller or the homeowner must correct it, and there is a trip fee for the appraiser to come back, typically around $150, for them to sign off on that discrepancy, whatever it may be. It could be a gate around an empty pool or even a lock. It could be a missing piece of a siding. It could be a broken window where there's access to the property. It could be trenches where there's electrical lines because people are doing work at the property that haven't been covered. So any of those things would trigger appraiser to make a note and say, hey, you know, there's work to be done in this property. I can't sign off this appraisal report as is. It's actually subject to them doing this report. I do have to go back there. One thing I will really note in this video, and if you're watching this because you're trying to figure out, you know, trying to order an appraisal and you're thinking, well, what could go wrong? Let me share this with you, and I share this with every borrower. It's very important. Before you order any appraisal, make sure you have these 3 things. Make sure you have a smoke detector in every room, in the hallway, and the kitchen. Make sure that you have a carbon monoxide in each floor of the home, and make sure that the water heater, if it's not tankless, is double strapped. Because if you don't have any of those 3 things, the appraiser is gonna mark subject to, and you're gonna have to pay an extra $150 in a delay for him to come back and sign off your report. Please give it a big thumbs up. Subscribe to the channel if you haven't done so already. I really appreciate you guys watching, and I will catch you guys on the next video. Thank you.